Silver has crossed a major milestone. This is documented data. For the first time, silver has moved above $100 per ounce. The advance came as gold moved closer to $5,000 per ounce. This is published information. Silver's price action did not happen in a vacuum. It unfolded amid clear forces in the metals market. Safe haven demand rose. Supply did not keep pace. Market expectations around U.S. interest rate cuts shifted. Physical liquidity tightened. Silver, gold, platinum, and palladium all moved higher. These are the facts. Silver's advance on Friday saw spot silver jump 4.05% to $100.1 per ounce by 15:47 Greenwich Mean Time. Silver's gain over the past year has been pronounced, up around 147%. Over the same period, it gained more than 200%, reflecting a long, sustained push higher. This is published trading data. Gold prices also rose in the same session. Spot gold increased roughly 0.48% to $4,959.98 per ounce. Earlier in the day, gold touched a record high of $4,967.03 per ounce. U.S. gold futures for February delivery rose nearly 1% to $4,961.20. These are documented price levels. Silver's move above 100 was set against a backdrop where investors shifted funds into metals during a period of elevated global uncertainty. Tariff concerns, geopolitical tensions, and uncertainty around U.S. policy were all present. The documented synopsis states that investors moved funds into metals because of global tensions, supply constraints, and expectations of future U.S. interest rate cuts. This is factual context. The article explains that silver's rise is tied to strong safe haven demand. Investors responded to global tensions. Tariff concerns contributed to an environment where metals looked attractive. Silver faced supply shortages and refining limits. Low physical liquidity in key markets supported prices. This is recorded supply and demand information. Expectations of U.S. rate cuts further increased demand for non-yielding assets like silver. The article states that markets still expect 2 rate cuts later in the year, after the January U.S. Federal Reserve meeting where rates were held unchanged. Silver and gold benefit during periods of lower interest rates because they do not offer yield. This is published market outlook. Platinum and palladium did not stand aside. Spot platinum rose 4.21% to $2,740.25 per ounce. HSBC stated that platinum is drawing demand as a lower cost option compared with gold. The bank expects the production and consumption gap for platinum to widen beyond 1.2 million ounces in 2026. Palladium also rose 4.79% to $2,012.11 per ounce. These are documented movements in other metals. Silver's advance above $100 has multiple factual drivers. Low physical liquidity in the London market supported prices. Supply shortages were present due to refining constraints. The article documents that the market struggles to scale up refining capacity. Physical supply remains limited. Safe haven demand, supply pressure, and tight refining capacity are not theoretical. This is published information. Investors reacted to global tensions, tariff risks, and uncertainty around U.S. policy. This is factual context, documented as part of the reasons silver is cruising above 100. Expectations around U.S. interest rate cuts added support. Expectations were that interest rates could be lowered later in the year after the Federal Reserve kept rates unchanged at its January meeting. This is an explicitly stated part of the market backdrop. Low liquidity, supply constraints, and safe haven demand have real effects on price. These are documented facts from trading data and market commentary. Silver's rally is part of a broader move across precious metals. Gold moved near record levels, closing in on $5,000 per ounce. Platinum and palladium also made notable gains. This is recorded market behavior. The article does not stop at prices. It also addresses what should come next for market participants. Investors are advised to review exposure to silver and other metals. Price movements remain linked to global risks and rate expectations. Diversification across assets may help manage risk. Investors are told to track central bank policy, supply trends, and demand data before making decisions. These are the published investor guidance points. Silver's advance above $100 per ounce is not presented as random. It followed documented shifts in demand and supply. It happened alongside other metals moving higher. It happened in a market where expectations around interest rates and safe haven demand were altered by real economic and geopolitical factors. This is not theoretical. This is published information. The article's synopsis frames the situation clearly. Silver crossed $100 per ounce as investors shifted to metals during global uncertainty. Supply limits, safe haven demand, rate cut hopes, and market risks pushed prices higher. Gold, platinum, and palladium also moved up. This is the factual opening picture from the original article. Silver prices rose above 100 on Friday. Silver's price rose 4.05% to $100.1 by 1547 GMT. Silver is up around 147% over the last year and more than 200% over the past year. This reflects strong demand and supply pressure documented in the article. Gold's price rise included an increase of roughly 0.48% to $4,959.98 per ounce. Gold touched a record high earlier in the day at $4,967.03 per ounce. Gold remains close to the 5,000 mark. Documented causes for silver's rise are safe haven demand, supply shortages, and refining limits. Low physical liquidity in key markets also supported the price. Expectations of U.S. interest rate cuts further increased demand for non-yielding metals. This is published explanation of why silver is rising. Future price direction, as described in the article, will depend on global risks, interest rate decisions, and changes in investor demand across metals markets. If current conditions remain in place, the article notes, silver may stay supported. Supply shortages, refining constraints, and low market liquidity could continue to limit availability. These are the stated possibilities based strictly on documented factors. The article includes direct statements about supply dynamics. Silver prices gained support from supply shortages. The market faces issues in scaling up refining capacity. Physical supply remains limited. Philip Newman from Metals Focus said silver continues to benefit from the same factors that support gold demand. He added that tariff concerns and low physical liquidity in the London market also support prices. This is published commentary. Silver demand rose as investors looked for protection during uncertain conditions. Silver also gained from investor interest in metals used for both investment and industry. This is factual demand information. Global risks and policy outlook also featured in the article's account. Since the start of 2026, several risks increased demand for metals. These include tensions between the U.S. and NATO over Greenland, concerns about the Federal Reserve's independence, and uncertainty around tariffs. Central bank buying and reduced reliance on the dollar supported gold prices. This is factual geopolitical context, documented in the article. At the January 27 through 28 Federal Reserve meeting, the U.S. Federal Reserve kept rates unchanged. Markets still expect 2 rate cuts in the second half of 2026. Gold and silver benefit during lower rate periods as they do not offer yield. These are the published interest rate expectations. Other metals joined the rally. Spot platinum rose 4.21% to $2,740.25 per ounce. HSBC said platinum is drawing demand as a lower cost option compared with gold. The bank expects the production and consumption gap to widen beyond 1.2 million ounces in 2026. Palladium also rose 4.79% to $2,012.11 per ounce. These are recorded moves in additional precious metals. The article's closing investor guidance emphasizes tracking central bank policy, supply trends, and demand data before making decisions. Investors may review their exposure to silver and other metals. Price moves remain linked to global risks and rate expectations. Diversification across assets may help manage risk. These are the documented closing points. Silver's price move above $100 per ounce, gold's approach toward $5,000, the movement in platinum and palladium, the supply dynamics, the demand shifts, and the rate expectations are all published. Factual elements from the article. This is documented information from the source article. Silver's movement above $100 per ounce is presented in the article as the result of converging, observable forces rather than a single trigger. This is emphasized repeatedly through price data, supply conditions, and policy expectations. The article makes clear that silver's rise mirrors broader behavior across precious metals. Gold approached $5,000 per ounce. Platinum and palladium posted strong percentage gains in the same session. This alignment is not described as coincidence. It is reported as a shared response to the same global environment. That environment is defined by uncertainty. Tariff concerns remain present. Geopolitical tensions persist. Questions surrounding U.S. policy direction continue to influence capital allocation. Investors responded by shifting funds toward metals. This is documented behavior. Silver's physical market structure is specifically referenced. Low physical liquidity, particularly in London, supported prices. Supply shortages were already in place. Refining capacity remains difficult to scale. These are not forecasts. These are constraints already described in the article. The article states that silver benefits from the same dynamics supporting gold. Safe haven demand increased. Expectations of future U.S. interest rate cuts strengthened interest in non-yielding assets. This relationship is explicitly outlined. Interest rate context is precise. The U.S. Federal Reserve kept rates unchanged at its January meeting. Markets still expect 2 rate cuts later in the year. This expectation is cited as a supporting factor for gold and silver prices. No further interpretation is introduced. Silver's longer-term price performance is also presented as factual record. The metal is up roughly 147% over the last year. It has gained more than 200% over the same period. These figures are stated without qualification. The article does not frame silver's rise as detached from fundamentals. Instead, it repeatedly anchors the move to supply limitations, physical availability, and demand behavior during periods of uncertainty. This framing is consistent throughout. Other metals reinforce the same structure. Platinum's rise is linked to demand as a lower-cost alternative to gold. HSBC's expectation of a widening production and consumption gap beyond 1.2 million ounces in 2026 is stated directly. Palladium's gain is reported alongside platinum's. No speculation is added. Investor guidance in the article remains measured. Readers are advised to monitor central bank policy. Supply trends and demand data are highlighted as relevant factors. Exposure to silver and other metals may be reviewed. Diversification across assets is mentioned as a way to manage risk. These points are presented without urgency. The article closes by reinforcing that current price levels reflect existing conditions. Global risks remain. Supply constraints persist. Interest rate expectations continue to influence metals markets. Price behavior follows these documented processes. Nothing in the article suggests abrupt resolution. Nothing implies sudden reversal. The information presented describes a market responding to real constraints, recorded policy decisions, and observed investor behavior. Silver above $100 per ounce is framed not as anomaly, but as outcome. An outcome shaped by supply limits, safe haven demand, liquidity conditions, and monetary expectations already in place. This is not speculation, this is published information. The article maintains a consistent emphasis on structure rather than surprise. Silver's pricing is described as the visible result of pressures already operating beneath the surface of the market. Physical availability is one of those pressures. The article states that supply shortages exist. Refining capacity remains constrained. Scaling production is not immediate. Low liquidity in physical markets reinforces price sensitivity. These conditions are already present. Demand behavior is another documented factor. Investors moved toward metals as global uncertainty increased. Safe haven interest rose alongside concerns over tariffs and geopolitical tension. Silver benefited from this shift in capital allocation. This is stated plainly. Monetary expectations form the third pillar of the explanation. The U.S. Federal Reserve held interest rates steady at its January meeting. Markets continue to expect 2 rate cuts later in the year. Lower interest rate environments historically support non-yielding assets. The article notes this relationship directly. Silver's performance is not isolated. Gold approached record territory near $5,000 per ounce. Platinum and palladium advanced sharply. This synchronized movement is reported as a market-wide response to the same forces. The article does not describe speculative frenzy. It describes alignment between demand, supply constraints, and policy expectations. Investor guidance remains restrained throughout. The article does not urge aggressive action. It emphasizes observation, tracking central bank decisions, monitoring supply conditions, watching demand data, reviewing portfolio exposure. These are presented as considerations, not directives. By the end of the article, the picture is complete without embellishment. Silver is trading above $100 per ounce. Gold is near historic highs. Other precious metals are rising. Supply constraints are documented. Demand drivers are identified. Interest rate expectations are clearly stated. The article leaves no ambiguity about causation as it presents it. Prices reflect existing conditions. Market behavior follows documented processes. The movement is already underway. This is the full weight of the information as published. Clear, measured, grounded in data.